You made it to the end of the week. Thanks so much for finding On the Markets for the brands of Fermata Advisors. Sonoma Wealth Advisors, our private wealth brand, Fermata 401k, Fermata Tax. It is Friday, August 22nd, and we've got a lot to talk about here late in the week because sort of like a groundhog who didn't see a shadow, the Fed president stepped out into the light in Jackson Hole today and kind of upended the entire market. Also, some interesting indicators from across the economy, including how childcare and lumber prices might be indicating a recession. And we have a very special guest we're really excited about. So let's get the show started.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the Markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, Fermata Tax, and Fermata Insurance. On the Markets starts now.
Darren and Chris Sipes, co-founders of Sonoma Wealth, and myself, Dan O'Weir. I'm the marketing director, joined by, I think, guys, this is our official first guest. Please welcome to the show, Bob Elliott. Welcome, Bob.
Thanks so much for having me. Appreciate it. I like that glamour shot. Nice slide.
You look serious.
You guys are the first people to test out this new set of headshots because my old ones were about 4 or 5 years old, and I got them for about $10 at the JCPenney. So these are a little nicer.
Looking good.
Chris tried to say we should get our headshots at JCPenney's too. He's that kind of guy, but I told him we had to upgrade a little bit for Sonoma-esque feeling.
We should do some Step Brothers style headshots at the mall sometime. Our guest is Bob Elliott. Bob Elliott is the co-founder, CEO, and CIO of Unlimited Funds. Unlimited Funds uses machine learning to create low-cost index replications of 2 and 20 style alternative investments that are deployed to a wide range of investors via ETFs and institutional products. Bob was recognized as one of the 2023 Tomorrow Titans by the Hedge Fund Journal. And Bob has prior experience on the investment committee at Bridgewater Associates, leading Ray Dalio's investment research team, and authored hundreds of Bridgewater's widely read daily observations. He may have a degree on his wall from Harvard. And Bob, we are very, very excited to have you on the show today.
Well, thank you so much for having me. It's great to be on here and on such a consequential day. So definitely a lot to talk about.
And of course, your hosts are, as I mentioned, myself, I'm the marketing director. More importantly, our managing principals, Chris Sipes and Darren Blonsky. And guys, today, as Bob is alluding to, as I've alluded to, we got some comments from the Fed president at the summer edition in Jackson Hole. And so I decided to make the name of this week's episode, I Know What You'll Cut Next Summer. Next September, I should say, because kind of like that movie, I Know What You Did Last Summer. Based on what Jerome Powell said today, Bob, it's looking like a rate cut is coming very soon.
Yeah, certainly he gave some indications that he was at least influenced by some of the softer payrolls numbers in the last report to suggest that what did he say? It may be appropriate to ease policy or shift policy, which would be more dovish in the near term. And so, is typically the case in most of these circumstances with central bankers. They'll never just come out and say what they actually mean. But I think he went from a place of, not that long ago, emphasizing that the labor market was, strong and that the labor market was, roughly at capacity, which is, what the Fed's mandate is, to one where he basically downplayed the inflationary pressures and expressed some concern about the labor market, which, is teeing up a rationale for cuts, if the data confirms it with the next jobs report.
Bob, given that the Fed's got this dual mandate of stable, price stability and full employment, Which one of those two do you think the Fed really places more weight on if it kind of had to choose between one or the other?
Well, I think it's increasingly obvious that price stability is not a priority for the Fed. I mean, let's take a step back. Core PCE inflation, which is their primary benchmark for measuring, price stability, has been above their 2% mandate for 52 months and is rising and likely to rise at least for the next 6 months or so, maybe a little longer, making it roughly 5 years of being above their price mandate. And so while they, said in the speech, we continue to, hold 2% inflation as our target, it is by no means a particularly credible target when you miss it by 5 years and are cutting when cutting at the same time that inflation is elevated and rising, and you're also arguing that we're roughly at full employment. And so, I think they've basically given up on the 2% inflation target with these steps.
Yeah, it makes sense. And it's strange. Darren and I have been doing this show for, I don't know, 5 years or so at this point, and I sometimes wonder if we're so focused on the Fed and we feel like everyone else is so focused on the Fed because we're kind of too close to following the markets. You've been a student of the market history for a lot longer than we have and involved in it. Has it always been this way where people really hang on every word the Fed says, and the market seems to just revolve around the Fed and their actions so much more than I guess you would even say for like fundamentals or some of the things that most people think of when they think of investing? It just seems to kind of be out the window and more, Fed centric. Is that the case, or is our perception distorted?
Well, I do think there has been a rise in focus on the Fed for two primary reasons in the course of the last, let's say, 3 or 4 years. The first reason is that as there's just a lot more Fed commentary these days. Like it used to be, it's hard to believe this, but it used to be like people would look at like pictures of Alan Greenspan and like the folders he was carrying in order to try and suss out what he was going to do. And basically there was no communication other than what rates were going to be. And so, the thing about that is that made life a lot calmer, right? Because you basically had no information until the day of the meeting. So, every 6 weeks you had to stare what was going on and the statement, and that's what you got. And now, I mean, these Fed governors are out every day. Like, I imagine they probably have something better to be doing than everyone giving all their comments about all the different things that they think. But that's the world we live in. So that's been a big shift, and I think actually one that's negative from a market participant's perspective, because it's just creating more noise. And then I think the second reason is in periods where there's more ambiguity about what the reaction function is, people are hanging on every word. And what I mean by that is like, it is unclear how the Fed will interpret the data that it's seeing. It's unclear at the level of last meeting, Powell made certain statements that suggested that the Fed would not cut further. And then now, with ostensibly the same data or slightly worse data, meaning slightly higher inflation data, essentially he's making an opposite claim. That flip-flopping of the reaction function from meeting to meeting, what can you do other than hang on every word and hope that you can figure out what they're going to do? It's very different than what you saw in previous, from previous governors.
Bob, do you think, one, why would he be doing the opposite with the same information? And two, if there is indeed a rate cut in September, is that a good or a bad thing?
Well, I think why is he? Why did he shift his position? I think you can't. The the only thing that has meaningfully changed from the data that Powell was quoting, you know, 4 weeks ago to today, is the only thing that has meaningfully changed is basically there's a lot more heat on the central bank. The heat's turning up, and no doubt, this may not be just Powell himself, because no doubt the statement that Powell said today was it was a collaborative effort among members of the committee. But it's pretty clear that the executive wants lower rates and is doing making a lot of different efforts to get what's desired. And in some ways, it's just a common sense, rational set of thoughts from the people who are sitting on that committee that they need to be responsive to the executive's wishes, or they'll experience undesirable pain in response.
And that big labor report, right, gives them a little bit of cover to make those changes. And if I remember correctly, Bob, I could be wrong, but wasn't there a similar adjustment last summer prior to the election and prior to that big rate cut, where something happened with the labor market and the Fed kind of almost panic cut? Am I remembering that correctly?
Yeah, so I think a lot of people will point to the cuts that happened last late summer and fall, and highlight that was, say, a politically motivated set of behaviors. But what I'd say on that front is we had a circumstance where we had before that cut, a reasonably significant rise in unemployment. We went from 3.7 up to 4.2 or a touch above that. Typically, if you just go and look at like traditional macroeconomics, when you get a roughly 0.5% rise in the unemployment rate, typically that is something that leads further rises in the unemployment rate. And so the Fed responded with cuts to that situation, I think, because there was a real worry that the labor market was sharply deteriorating. Now, I think that was it was a bit myopic from the perspective of that was very focused on the unemployment rate itself. If you looked under the hood, a lot of the reason why that unemployment rate was rising was because of the significant labor supply, and so essentially this labor supply started to contract or slow, and you saw a stabilization of the unemployment rate. And so I don't think actually it was a meaningfully political move last summer and fall, because the unemployment rate was moving so sharply. Here, there's not a lot here for them to stand on when it comes to sort of making the case that there's a rapid deterioration in the tightness of the labor market. Remember, the Fed doesn't care about the growth rate of the labor market. They care about the tightness of the labor market. The unemployment rate has been flat for a year at this level. Powell even mentioned a bunch of different stats that suggest that the labor market has been roughly stable for, from a tightness perspective for reasonable, for the last 6 months or something like that. And so this really does have all the hallmarks of a politically motivated or at least influenced shift in rhetoric and possibly policy ahead.
Well, Bob, we saw definitely a positive reaction from the market today in many different sectors as a result of these comments. So we've got a political cartoon up here, a little meme up that says it's a child being held up that says, "Me thinking I'm good at investing," as he's making a dunk, and it's the dad holding it that says "bull market." So based on these comments and a potential rate cut, bull or bear right now for you?
In terms of the market environment right now,
Yeah.
I mean, we are. I'm just enjoying that drawing.
I literally laughed out loud when I saw this, and my wife, we're sitting at the kitchen table. My wife's like, "What are you looking at?" And I showed her. She's like, "You're such a geek." Like she was not. She's like, "Why are you laughing at that? That's not even funny."
It's pretty funny.
And I have to apologize to Dan because I got the edges off on this, so it's probably driving Dan crazy right now.
It's only funny because every other conversation we've had with investors in the last 5 years and them saying, "Hey, I'm a really good stock picker. I'm a great investor." And few people realize how stimulative the government has been and how much cash they've actually pumped into this market.
Yeah. I mean, for all the conversation about the Fed, we do have from a broader perspective, a situation where we have a range of negative growth policies that continue to drag on the economy, things like the constriction of immigration and tariff policy, which is causing a hike effectively a tax hike on U.S. households and businesses, and so the combination of those two things has already created a slowdown in the economy. Remember, sort of real final sales, which looks through a lot of that noise in terms of the imports and how it's not accounted for in inventories quite as well as it needs to be, was at 1.2% for the second quarter. So I think the question becomes, if we're growing in that ballpark at like 1%, or maybe a little lower as we get sort of the full effect of tariffs and immigration, that's pretty far away from what's being expected in the markets right now with markets at all-time highs. And so, a lot of folks look at the Fed, and I think this kind of goes to the conversation about, people being in some ways over-focused on the Fed and think that the Fed's policies are going to meaningfully alter the trajectory of the economy. And remember, the Fed hiked 500 basis points and largely the economy was fine. There's no reason to believe some incremental 25 basis point cut or 50 basis point cut will do anything when it comes to keeping the economy afloat if it's slowing down or growing less than expectations. And so I still I still see an environment here in the second half where growth is expected to be a lot stronger than what is likely to occur, and that's typically a negative environment for equities.
Darren, when you're sitting down with clients and looking over their portfolio, is the third thing you tell them to marry right?
Marry right is not what I tell them, Dan.
Chris, you've got a little meme here from Warren Buffett up top.
Uncle Warren
says yes. 10 rules for financial success: budget, buy assets, marry right, pay off debt, invest in yourself, avoid lifestyle creep, cut unnecessary expenses, invest 20% of your income, be with business-minded people, create multiple streams of income. Why'd you include this week?
I included it. Well, one, anything with Warren Buffett on it is probably going to get my attention. And don't tell me if you know bad things about him. I don't want to hear it because I just want to have this perfect human in my head. Although I've read, I think it was called The Snowball, that was kind of more about his personal life. That he didn't have anything awful, but he's a human too, like the rest of us. But I love this because it's things that the average person can do and control that will have the biggest impact on your finances. I feel like a lot of times people come to us and they expect the biggest impact on their finances is going to be out investing the next person, or they're going to invest their way into retirement. And the truth is that you are competing with people like Bob and others that have way more resources. I tell people, like, equate it to say, I'm going to go play basketball, and I'm going to jump right in and go to the NBA All-Star game and just see what happens, right? You're going to get smoked. So do what you can control and do the things that are going to have the biggest impact on your overall lifestyle and your retirement. These things aren't all retirement, by the way. Things that give you huge psychological wealth, like paying off debt. The marry right thing, anybody that's gone through divorce knows that one is a huge financial and emotional burden. So these are ways that you can build your overall wealth. And in most of these cases, you have a lot of control over these things. You may not be able to get all 10 of them, but I think if you get a majority of these, you're going to be pretty happy and have a nice overall wealth in your life.
Bob, the audience for our show is our clients and our prospective clients. So a lot of, kind of the average investor. Which of these rules kind of jumps out to you and rings true?
Well, I think it's interesting. I think from an old school perspective, the idea of I'd say living in a world where you're not taking on significant debt is, I think, sort of a key sort of strategic way of operating, and that will in many ways help you with a lot of these other things. Meaning, like, if you are only paying cash for a home that you're going to live in, well, then you're not going to have lifestyle creep because you'll only buy it if you have the cash available. Or, if you're not borrowing to fill the gap in your spending, then you effectively are creating a budget for yourself. And so 10 rules is a lot for people to keep in mind. And so from my perspective, from a personal finance perspective, like, start with no debt. If you operate in your financial circumstance without any debt, the odds that you run into a significant risk are just radically lower than if you operate with debt.
Great advice.
I was just thinking about the markets, and I was thinking, it's kind of interesting. Like, it's probably one of the few environments where any Joe Schmo can go play against a pro player, right? If you think about it, like, imagine going to an NBA game and walking down on the court and thinking that you're going to have any chance against beating Steph Curry. Like, just not going to happen. The dude's going to sink threes on you all day long, and you won't be able to stop anything he does. In the market, it's really built in a way that you need people going to the market who have no idea what they're doing so that the market can take the money. It's kind of interesting how that's set up, but
even worse, because of just pure luck, that meme of bull market, great investor. Sometimes you can go in and just fall into, an amazing investment with no skill at all, right? So it's kind of like walking on that NBA court and putting up 40 points and 10 rebounds just out of pure luck, which would also never happen, right? It's one of the only professions where sometimes being smarter doesn't even help you. It's you wouldn't walk into a surgery room without being a surgeon and just happen to perform a great surgery. It's really wild how that works.
I'm pretty good with the scalpel, but
Yeah.
sewing it up, you're screwed.
I can't even play operations. So this is let's look at consumer sentiment, investor sentiment this week, Chris. What do we got?
So we check this every week to kind of look for extremes more than anything, because usually when you get an extreme, that's a contrarian signal in some ways. And even though there's a lot of things kind of happening in the market that seem borderline euphoric, somehow the overall sentiment indicators are pretty normal right now. If anything, people are a little more bearish than average. So not a huge signal this week in the sentiment indicators. The CNN Fear and Greed Index, which is more based on positioning, was at neutral this week, down from 63 last week, which was greed. And then the Bitcoin Fear and Greed Index was also at neutral at 53, down from 75. And we particularly kind of follow Bitcoin as a telltale for risk assets in general. And I feel like this also happened over the last week when I think Bitcoin hit maybe like 124 or something, and then dropped pretty quickly to like 112-ish or something. So the market, then was struggling until today, of course. So Bitcoin again, kind of being the leading the charge on risk assets, and so just keeping an eye on how people are feeling around that. Hopefully can be helpful.
Well, how people are feeling about the potential for a rate cut. Chris, we've got the target rate probabilities now for the September meeting.
Yeah, and purposely we put this in last night before Jackson Hole because I wanted to see how much it changed. And surprisingly, I was messaging you about this, Dan. Yesterday, it looked like the quarter point cut was about a 75% probability. Today, it only went up to like 87, I believe, after the Jackson Hole meeting. And so not a massive change, despite the huge rally in the markets. I fully assumed when I logged into the CME FedWatch tool that it was going to say, 100% chance of a rate cut and maybe, half a point with as much as the market rallied today. I thought that those expectations had changed dramatically, and they really hadn't. So that was interesting.
Yeah, that is interesting. I wasn't. I would have had the same intuition that they would have gone to essentially 100%. It certainly, seems like there's a real question about whether the confidence that the market has in the cuts ahead might be a little overblown. Yeah, I mean, even if you look at the December numbers, they look about the same as they were yesterday, like the December 2025s, in terms of the pricing, which is interesting for sure. So
yeah,
a lot of positive sentiment coming from a relatively de minimis move in the markets, the short rate markets at least, I should say.
Bob, were you surprised by what Powell said today? Were you expecting this, or were you surprised?
I mean, I think I was surprised that he was so moved by the political pressure that he's been facing. There's certainly he has at times acted defiant and at times acted submissive to the will of to Trump's will, and I wonder how much what we saw with Cook earlier in the week created fear, to be frank, amongst Powell and the committee, that they needed to operate more consistent with Trump's desires.
What do you think they're fearful of? Like, I mean, at this point, what can the guy do to him other than just bash him in the media?
Well,
like,
what are you talking about? He's going to throw Cook in jail. Like, that's what he's going to do.
Tell everybody kind of what was happening with Cook, because I think a lot of people miss that and may not know what you're talking about, Bob.
So Cook, who's a governor appointed by Biden, the head of what's his role as the head of
Pulte, the housing. He's like the
housing secretary. Basically, went and looked up some mortgages that Cook had applied for, and basically it looked like, well, the claim is, I have no idea what's true. I'll just report what was in the media. But his claim is that she said that the house was going to be her primary residence for 2 mortgages applied to within a short time frame, and that that could be considered mortgage fraud, because obviously you can't have 2 houses that are your primary residence it has to be for at least a year or 2. I don't know exactly the details of it, but that's typically what it is, a year or 2 that you have to affirm. Obviously if they're within 6 months of each other, it would be, you would have a hard time claiming both would be your intended primary residence. So I have no idea what's true and what's not true, but it was referred to the Justice Department. The Justice Department has confirmed that they intend to pursue criminal action against her. And so, and to be clear, just for context, this activity is not something I would do, but in a review of mortgage applications done by the Fed, they found that roughly 10% of all mortgage applications had some sort of situation that was like this, where someone claimed primary residence when it was unlikely to be their primary residence. So this is not, it's not quite akin to speeding, but it's certainly not akin to murder, in terms of its frequency out there. And she will probably, they will probably, pursue her aggressively. And imagine you're sitting there on the committee, and you know that the folks are going through every tax filing you ever made, every piece of paper that you've ever signed in your entire life to try and find something that's going to cause trouble for you. It's tough. I empathize with being in that situation.
And just looking at pictures of Powell and how much he seems like he's aged here recently, along with that super uncomfortable press conference at the at the Fed when Trump came by to visit him. Powell strikes me as more of a banker than a politician, and I don't think he enjoys this at all. I mean, I could be wrong, but it seems like the type of spotlight that would just be super uncomfortable for someone like him. He doesn't seem like the type that thrives off of it, that's for sure.
Chris, I imagine like you having that kind of, like you're the last person
no way
that would enjoy that.
I would hate that more than anything.
Like, that's like Chris.
Yeah. I don't even like people to recognize me at the grocery store, so I can't imagine the pain of that.
There's Powell at the
what's
start. There's Powell at the start when he first was appointed.
Wow.
I like
Think
that.
about that. Just think about
like
that. That's an awesome tie. All right, back
So
to work.
that is a 10 out of 10 tie. I feel like we should get back to the fat ties,
Yeah. I like that.
The skinny tie era coming to an end.
I forget the skinny tie area. The good thing about fat ties is, for those of us who carry a little extra weight, the fat tie makes us look skinnier. So.
That's right.
That's right. Well, in Sonoma, the good news is, Bob, not many people wear ties, so you don't have to worry about that.
Come on out.
So Bob, if we're wrong on this, you can let us down easy. But we've been telling people for quite a while, or I've been telling people for quite a while, that the 2-year rate might be looked at as a market judgment of what short-term rate pricing should be, or a ballpark of short-term pricing, and that the Fed funds typically follows the 2-year Treasury over the long term. Sometimes lags behind it, sometimes is in front of it. But overall, that the 2-year Treasury could be looked at as the market's pricing of short-term rates. Do you somewhat agree with that? Not agree with it at all? Where you fall on that?
It's definitely the pricing of it reflects the expectations of or market expectations of future monetary policy over the next couple of years. I think what you see on that chart, I think is actually quite interesting, where there's a meaningful shift starting in sort of mid 2022 from essentially the 2-year rate largely leading very consistently what happened with monetary policy, to wild swings in the 2-year rate at a time when there's relatively modest moves in monetary policy. And that's important, because I think what you're seeing here is that it's a reflection of that conversation I was having before about the uncertainty of the reaction function from the Fed, right? Like inflation, economic conditions, they didn't wildly move from month to month over the course of the last 3 years. but expectations of policy action have wildly shifted. There was a time at the beginning of last year when 7 cuts were expected, right? Remember that? And then it went to essentially 0, and then it went to a few.
Yeah.
And so I think that's what you're seeing here. And so unfortunately, I think it's less, it's not that good an indicator of what's likely to transpire. More an indicator of sentiment of what markets think will transpire, but it hasn't been a very good indicator.
Mm-hmm. Yeah. And what's interesting too on looking at this earlier was the spread here, which is roughly 75 basis points, right? And
Yep.
If you go back to last summer before the Fed made that big cut, that spread was higher. It was closer to 1% at that time, before the Fed made that 0.5% cut. So, I think we've been showing this to show at least that the Fed may be a little tight, but it's definitely not so tight that you'd say it's egregious and obviously politically motivated at this point, that they're keeping rates high. To me, at least, looking at this data, they're at least in the ballpark.
Yeah, I mean, there's a range of different Fed models that they publish on a regular basis, largely connected to the Taylor rule or derivations thereof. And they say something like, between 4 and 4.5 in that ballpark in terms of what would be the appropriate rate under current conditions. And yeah, so it seems in the ballpark of what the appropriate rate is.
Yeah. All right. So we got a chart from Ed Yardeni Research. He puts out a lot of, I honestly don't know how they put out as much as they do. He's got just, if you sign up for any of his research, you get prepared. You're going to know everything of every second of every day. But the quote here from Yardeni is, the index of leading economic indicators has been a misleading indicator of an impending recession since late 2022. And Dan, I don't know if you can take off the little thing up in the corner so you can kind of see the chart, because
It's gone.
you loosely see that the red line, which is the S&P 500, has somewhat followed that LEI in some ways, except for now, right? And you can just add this to the tons of indicators that seem to no longer hold the same weight as they used to. I think, Bob, you were talking a little bit earlier about the unemployment, and I think it was last summer we had the Somm rule triggered, and then Claudia Somm went on a lot of different outlets, but I heard her on, I think it was Odd Lots, and she's like, look, I don't think it's working anymore. Like, yeah, it got triggered, but I don't think it means what it's supposed to mean now. And then you've got the inverted yield curve, which Campbell Harvey's also said, look, I know it worked all the times in the past. I think it was 8 out of 8 times in the past to predict recessions, but this time it could also not work. And so it's, from I can't imagine from a Fed's perspective, which is trying to look at all these indicators, just like we are as advisors and just like you are as a fund manager, and try to figure out what the market's going to do when it seems like the market is not responding to any of the things that it has in the past. Do you think that's fair?
Well, LEI has a little bit of some challenges in LEI because I think some of the fundamental reasons why it was a good measure sort of back in history are less important today. Things like, the yield curve was very important for banking behavior, and obviously banks are not so important in terms of credit provision today. It's very focused on manufacturing as being an important component of the economy, where obviously manufacturing share of the economy has gone down a lot. So it's not a great indicator these days. I think a somewhat better relational thing today would be like, how's growth doing? And what you see is that mostly growth conditions, and particularly growth relative to what's expected continues, has largely continued to be a good indicator through the end of last year, meaning like 2022 was weaker than expected and stocks were weaker. 23 and 24 were stronger than expected and stocks went up. Really, that divergence between the real economy and asset prices has really emerged this year, where we're seeing stocks push to all-time highs when growth is not only weakening but also weaker than expectations. So, that's a notable divergence. Such divergences happen through time, but they typically, you typically don't have stock prices making new highs while the economy is slowing for much more than 6 or 12 months, if you look back through time.
Yeah, and it's interesting kind of how concentrated and abnormal the market's been recently. We've talked a lot about how, small caps really haven't gone anywhere for 3 or 4 years. And there's been this like phantom recession, and this being another area, which is the housing market. We're looking at the National Association of Home Builders Wells Fargo Housing Market Index, which is down as low as it was in COVID, in the recession in the early 90s, only exceeded in the GFC, which was a real estate centered recession in many ways. And so, and yet home prices are near all-time highs. So it's as though this recession isn't really happening, even though the housing market seems pretty unhealthy under the surface.
Yeah, I mean, housing's clearly cracking. If you will get a bunch of data on sort of prices and transactions next week, but we've had a couple of months of negative home price appreciation. When you look at something like Case-Shiller, you have permits at cycle lows. You have transactions that are very soft and much more supply basically coming onto the market than demand these days, certainly at these interest rates. And you sort of look at that whole picture, and housing's clearly a drag on the economy. It's probably not quite big enough to be a sort of full-scale drag on the economy, but it's more like, of all the different areas, you put that one as a minus down as you're thinking about the various sectors of the economy.
Absolutely. And this was from Residential Club. They said that by way of the New York Fed said subprime borrowers, those with credit scores above 760 who carry unpaid student loan balances, saw their credit scores drop by an average of 171 points this spring. This sudden credit hit is temporarily pushing some would-be buyers out of the housing market. So I guess maybe this has something to do with the pause on student loan debt, and maybe that was lifted. I don't know the details well enough, but it looks like the impact of those student loans are having a huge hit on credit scores, probably mostly for younger borrowers. This combined with a chart that didn't make it into the slide deck this week, but for the first time, I think ever, male college graduates' unemployment rate is the same as non-college graduates. And so that seems significant as a young person trying to make it in the economy these days, and it makes you wonder kind of the fragility of society. We all know that usually disaffected young men, it's not a great thing, right? It seems to be that can trigger some problems.
That was all of us at one point.
Yes, absolutely, to different degrees, right? But
hey, Chris, let me jump in for a sec. So, Bob,
yeah, go ahead.
Question for you. I'm curious to get your opinion on this. AI, right? Everyone has an opinion about AI's, what it's going to do, how it's going to impact the economy. One of the things we're seeing is unemployment among college graduates, entry-level jobs seems to be rising. How are you looking at AI and its impact on your framework for the economy?
Yeah, I mean, I think there's a couple different ways to think about it. The first is there is clearly a boom in AI related, let's call it investment, and spending that is, that has, to the extent that Meta and Google, et cetera, are building data centers and things like that, that has a direct support to the economy. There is sort of I'd call it sort of a limit in terms of how big that can be. Maybe it adds 0.5% to growth, even with pretty positive assumptions about what that looks like. So that's not really gonna, like, that sort of AI investment and spending is not really gonna drive the economy. The real question is, are we starting to get a meaningful improvement in productivity to support the economy? And there, if anything, actually, we've seen productivity measures soften over the last year or two, and so it doesn't look like it's translating into that, into productivity. It might, like, if you look at basically how computers translated to productivity, it took 30 years from 1980 until really 2010. I mean, it literally took that long to get the full productivity effect. Maybe this goes half as fast in terms of the productivity effect, but that's still a long time and a lot farther out than most people are expecting. When I think about the sort of new college graduate challenge, typically that sort of dynamic is more cyclical than it is secular in nature. And if you look at things like hiring rate at the economy-wide level, you see that we're not far off of recession levels from a hiring rate perspective. And so it's normal for sort of the edges of the labor market, whether it's new college graduates, whether it's those folks who are 16 to 24, you're seeing their unemployment quite a bit worse than normal and rising. So it's sort of those corners that are starting to feel the effects. That's more of a cyclical dynamic. At least historically, it's been more of a cyclical dynamic.
So you think that where we're seeing the edges get trimmed on unemployment or on employment at this point is actually not necessarily AI that's creating that, but more a cyclical impact of the economy flowing.
Yeah, I mean, what you see, just as a simple example, you see like relatively full employment in the 25 to 54 cohort, prime age workforce, and there's no reason to believe that like AI would be particularly like only affecting early college graduates or recent college graduates. That doesn't really make sense, since there's people in the prime age cohort that are working all sorts of levels of jobs. Like if you thought, for instance, a paralegal was particularly affected by AI, like they would be mostly in the 25 to 54 cohort, not in the recent college graduates cohort, right? And so things like that kind of give an indication, kind of show, could also the fact that hiring rate is low, and has been low for a while, like that all kind of looks cyclical to me, not secular.
And Darren, I don't have it handy, but I just saw a study this past week from a behavioral standpoint that one thing that goes unnoted when it comes to the employability of the college grads is there's a real Gen Z culture problem and work ethic problem as they come into the workforce. So low key, bruh, it might be your Riz that's causing the problem in the internet.
You're sounding like an old man. Literally.
I love that. That's perfect. I wish, I wish there was some way to get, I'd be interested in seeing that study, because I haven't found a good way to any sort of quantified impact of the cultural aspect, or whether that's even a real thing, right?
I'm a little suspect. People. It's a real thing, us? Right? It's
that's us?
I feel like every generation has said that about the younger generations coming behind them. But
I haven't been doing this forever, but I've been alive for 45 years, and I remember when I first started in the workplace, everybody was complaining about my generation, how they didn't work hard. Yep. And then we all had kids and got mortgages, and nobody's complaining anymore because we're all working hard.
Yeah, speaking of kids and mortgages, this childcare chart, I feel like everybody warns you when you have kids, you're not going to sleep. And they should be warning you, hey, you're signing up for another mortgage when it comes to childcare payments. And I really wish we could see a chart of this over time as to what percentage of incomes this has been, over the long term. But it's significant, right? So it's another thing that would count, for a young family would be a hurdle to owning a house in a market like we're in today. If you're already pushing close to half of your income going towards the house payment, then you've got another 10 to 12% going towards childcare. There's not a whole lot left for anything else.
Yeah, I mean, I think I think people talk about the childcare problem as like an affordability problem, which obviously it is. But I think the thing that gets missed in that is that it's a long-term growth problem. Like it, we are being short-sighted in approaching this problem, because essentially, if you think about it, like the long-term wealth of a country basically comes down to two things, which is how many people are working and how productive are they at working. And the worst thing you can do for the long-term wealth of an economy is to create essentially incentives or create barriers to having population growth. And so I see these sorts of things and I say to myself, like, we're talking about all these sorts of marginal policies of, like, I don't know, investment expensing being accelerated, stuff like that. Like, the most effective long-term growth policy that could be implemented would be to cut the top third, to means test Social Security, and essentially cut the top third of spending on it, and give every person who has a child 10 years of a $10,000 tax credit. And if you did that, it would pay for itself over the course of 20 years. It'd be the best investment we could make. But I don't think anyone's gonna vote for me if I say that we should cut seniors' Social Security by a third.
Yeah, and all the parents are too busy working to be able to go vote for that. So
exactly right. That's funny.
We can jump into candles, guys. I know I got so excited that Bob was going to be on. I just crammed us full of charts. So let's just go ahead and jump into candles. So
I think we got to wrap it. We're wrapping for this week.
Yeah,
So-
Chris, let's just do this one last slide because we want to give Bob an opportunity to talk about overvaluation. And Chris, why don't we do this one last slide and then we'll wrap.
Gotcha. Okay. Well, I hate to keep beating this dead horse and being the wet blanket on the party, but this was posted by Lance Roberts, and he says valuations, which are a terrible market timing indicator, obviously, are certainly at levels that investors should be mindful of. While it seems like the market is unbreakable, historically, such has never been the case. And this is interesting to see this chart in a week where Howard Marks, another respected investor, came out with his memo, something, I can't remember the exact title, but it's about valuations. It's a great listen. And for, investors and professionals alike, I think it's a good thing to listen to. And, one of the things I thought about having Bob do, given that he's a history major, is sometimes it's helpful to compare a current time with a historical time that people are completely separated from, where they don't have the emotional attachment to it. So it's hard to say, well, this is like the internet bubble, because most people lived through the internet bubble. We know what that was like. So maybe it would be more appropriate to, compare it to something like the railroads, because, that was a game-changing technology at the time. It also generated a huge bubble in the markets. It did end up changing our economy and our lives in the most massive way. And it affected the market such that people got euphoric about it. It got way overpriced. There was a bubble. There was a crash. Even though railroads went on to do everything that we thought they would, which was completely change, our lives. So I guess the point is, be careful. We all read into these narratives. Stories are good in bubbles. That's why we all, buy into it. And I think it's just a time for caution, given that all of these different measurements, whether you're looking at trailing price to earnings, forward price to earnings, cyclically adjusted price to earnings, price to book, enterprise value to EBITDA, Q ratio, on and on and on. There's hardly any metric you can look at that says, yeah, the market is cheap. Jump in with both feet. Don't worry. Nothing to worry about here. So I know that's a tough thing to talk about on a day when the market rips up on Jackson Hole News, but there you go.
That line's just a little bit higher today. Yeah, that was January 2025, so we got a little bit higher than what you got going on there. I think one of the challenge with any of these valuation measures is they don't, anyway, it's not necessarily a good indicator over a time frame that people care about, which is something like 6 to 12 months. But a much better indicator of these things is how is the economy coming in relative to expectations. Meaning, like, you can have a bubble persist as long as the economy is good. Bubbles can persist. What causes the reversal of bubbles is when you have the economy weaken, and particularly weaken a lot more than people expect. And that creates essentially the topping mechanism. And so I think that's part of the story here is, like, in 1998, there's a reason why the bubble kept going in 1998, because, like, things were good, like it was the economy was booming. It was only when the economy started to meaningfully slow that you started to see a reversal there. And in the spirit of your pick a historical example, there's a lot of stuff today that looks a lot like the late 60s when it comes to the dynamics at play.
Space race.
Yeah, in terms of large fiscal spending, wars, efforts to essentially support the poor folks from, like, a industrial policy perspective. There's a lot of stuff that's like that going on today, and I should say monetary policy that was lagging overall deflationary conditions that were emerging in the late 60s. And so you sort of put that all together with very high valuations, and that sort of gives you, it's a period worth studying, the late 60s, for sure.
We are going to wrap the show here today with our very first guest, and you can find him on Twitter. He is, X.
We still call it Twitter. We still call it Twitter in a moment of defiance to the current overlords.
With X is, like, every time you say X, you're like, you pause for a second. Like, I'm talking, no, not like Pornhub or something like that.
Oh my God. Bruh.
It's just not right.
If you say Twitter, everyone knows what you're talking about. That's all I have to say.
X, everyone looks at you kind of crooked still.
You can find Bob on Twitter at Bob E Unlimited. He is the co-founder, CEO, and CIO of Unlimited Funds. Bob, thank you so much for joining us on the show today. We really appreciated your insight. We'd love to have you back sometime.
Yeah, for sure. Thanks so much for having me. It was a lot of fun. Enjoyed all the charts.
We had a special look on the markets this week with our special guest, Bob Elliott from Unlimited Funds. We thank him for joining us. Now we are going to jump into the charts with Darren. As we talked about, Jerome Powell made comments at Jackson Hole, the Fed president, and those comments gave us a lot of green, Darren.
Yeah, lots of green today. I'll go back to what we've said many times, I think, on the show, is that, going back to there were people who were excited Trump won, people upset that Trump won. At the end of the day, printer's going to print and the market's going to respond the way it responds. And so today we're looking at the S&P 500 in front of you on the screen. This are the candlesticks for the S&P 500. You can see we traded right around 63.50, let's call it. And found support. We can move up this support here. We'll use this line right here. You can see where the support was, and then we came right in to resistance. I always find it so interesting how the market, like, literally almost to the point, trades to certain areas. And you can see that right here where it traded right into that all-time high, got rejected and sold off, didn't quite break over it. I say that's positive on its face, the fact that we got that nice move. I'd say it's semi-bearish, though, that it didn't close above that all-time high, even on that news that potentially we're having a rate reduction coming up here in the S&P 500. For those who don't know what the S&P 500 is, it is the largest 500 U.S.-based stocks. This is a heat map. This represents the S&P 500 as its capital weighting, meaning the bigger companies get bigger boxes and the bigger companies have a bigger influence on the index. So if the bigger companies go up, so does the index. You can see NVIDIA being one of, if not the largest stock now in the market. Don't recall if Microsoft or NVIDIA are bigger, but anyway, it looks to me visually, at least, NVIDIA is, and you can see NVIDIA is larger than the entire financial sector, larger than the entire oil sector, larger than the entire healthcare sector. So we've got a very overweighted economy going on, as we just learned in our segment with Bob Elliott for our macro discussion today, that these bubbles can keep going as long as the economy keeps meeting expectations. And that certainly seems to be the case. And the government certainly figured out ways to keep that going by printing. So
NVIDIA is bigger than Microsoft.
It is. Okay. It looks bigger on here, but I just wasn't 100% sure. And that's thanks for that clarity. So if we look at our 1 week performance, though, not such a great week in the market, but a 1 day in the market, not too shabby. And that all came on the backs of Jerome Powell talking at Jackson Hole. Part of the issue is the Trump administration's putting a lot of pressure on Chair Powell and his other Fed governors, including investigating one for mortgage fraud. So I guess the thinking is that they're going to capitulate at this point. At least the market certainly seems to be signaling that.
You know, one thing we didn't cover during the all the market talk is, and it kind of just blew away because you went through, the fact that the market was struggling for the week. I think it was Meta that said they were like reducing their AI division, right? And the market really did not like that news. And
they're freezing. So Meta has been on a AI hiring spree, hiring guys away from Alphabet, etc., Apple, etc., for $100 million, and they've since said, "Hey, we're on a freeze now." So it's unclear whether that means, "Oh, we've got our squad now, let's get to work," or whether it's like,
the
summer's cooling off.
Forget being a professional sports player, like. Go be a Meta engineer, right? But yeah, I mean that the market really did not like that news. But of course, that's all been covered up with the Jackson Hole rally today.
Interesting. Here you've got what I would call a double bottom forming in the S&P. This would be the neckline of that double bottom, suggesting maybe we go higher. So there's going to be a lot of resistance at 6,500 on the S&P. We got to break through that. And I'd say that's a little bit bearish that the good news of the rates potentially going down didn't push that through. When we look at the 10-year chart, all in all, like the rates didn't fall through the floor, right? We're still in trend. We're staying right in this area. Looking at this from a technical standpoint, you can kind of see this. That's an ugly line. Let's do this one. You can see this triangle here that it's kind of forming, which tells you there's probably a decent size rate move coming. So you can see that there, where I would say that this is supply and demand getting tighter and tighter until you get a break down or break up. So I am of the feeling that there's an event coming. I think it also just happens that the seasonality right on cue. We're walking into September. Get ready for the world to be ending and the market to plunge for some stupid excuse. And then come mid-October, it just ramps up into the end of the year. So I'm just waiting for it. I don't know about you, Chris, but waiting for the narrative for our September slam to come on in.
These are the strange things that financial advisors look forward to, I guess.
I know. It seems like the last couple of years, though, we kind of get this float higher in August, and then September, the markets tend to get volatile, and it'd be some geopolitical temper tantrum.
There'll be a reason, Darren. It won't be for no reason. We'll find a reason.
Oh, we will, for sure. In retrospect, it'll be obvious.
So clear.
Let's take a look at gold. So we've got gold, and gold's just continue to consolidate. Pretty excited actually on our other show we've got coming up. It's all out money. We've got a gold expert coming on pretty soon. So that's going to be fun here the next couple of weeks to talk about what's been happening in gold. I'm starting to see this as distribution in gold, meaning that eventually the buyers just get worn out at this area and then it falls down and falls through. It feels like it's just been going on too long. And we're not getting any further movement. You could also say, which is interesting, that this chart kind of corresponds with the 10-year. And if you look at that same kind of triangle, consolidating triangle building up, which either we're going to break out or break down. I mean, you could make an argument, right on time, September, gold goes up when things start falling apart and the world is going to end in September. And we have our excuse for the market to fall apart. Interest rates then go down. Fed has reason to move rates down. You could see that narrative almost kind of starting to construct itself inside the markets right now. When we look at ag, bonds definitely looking strong. Bonds liked that interest rate move today. Interesting though where we're at. You can see, Dan, I just have to say, with all our Disney talk, you're getting very, very accustomed to double tops, my friend. So let's just compare the egg chart to the Disney chart at this moment.
We can't have that conversation on here. We can't talk about that.
So
Disney is a stock I've been following. I went to Disneyland. I went to Disneyland with my family, and so I've been following that just out of curiosity.
The only good news,
and Darren wants to give me mess about it.
The only good news about Disney is that you're not talking about the NFL, Dan.
Or Nintendo.
So you have a double top. So this is called a double top. This is the neckline of a double top. And so this is a much longer time frame on a chart, but you can see it goes down and it works its way back up. Now it's testing that neckline right now. So it's a really important point in the chart for ag, because if ag comes up to here, gets rejected from this point like this and goes down, that's confirming that resistance point, right? And magically, Disney looks very similar. So let's look at this pattern again. This is what guys like me, as we sit around and think about patterns in the markets, because our brains don't turn off late at night. Okay. So this is on a smaller time frame. Dan, you're just going to be so impressed that this is almost exactly like the egg chart, my friend. But here, what's interesting is you have a double top. You have underneath that, we found support around 111, 112. Trades up, hits resistance. But see that wick there? That means at some point during this session today, Disney had broke above 119, was trading higher. But then as soon as it hit that, that meant a lot of people had sells put in. And those sells then sold that price off, which then confirmed the resistance here. Now, the very next step we're going to be looking for is the follow through. So either it's going to go up like this and we're going to actually see it like you're surmising, Dan, or we're going to see the resistance hit and it will trade down and confirm that pattern. This becomes resistance. After that resistance confirms itself, there's definitely some local support around 116 in this area. You can see how important this area was on the chart because it traded around that area for 1, 2, 3, 4, 5, 6, 7 days. But once it loses that, it's got to come back in and test this support at 112. Now, the thing is, when it comes to charts, is the more often price visits a particular, so more often the chart visits a particular price, the more likely it is it's going to break through that area. So for example, if we see the next few days, this chart trade right in this area here, it becomes more and more probable that it's going to go higher. The fact that it rejected during the session today tells you that there's a lot of sellers sitting there. So when price comes up to 118, those sellers are saying, hey, I'm out, sell. And a lot of that's all happened electronically. So when you look at that on a 1 hour time frame, you can see this is that double top I'm talking about. Trades down in, finds support at 112, comes up, and this is the bearish close on this one. The fact that it broke above that, came in, tested that, and closed right there. There wasn't a bounce. So what I would have wanted to see if I said, hey, this is bullish, a break up, break down, and break further up. So as soon as it hit that, it would have shot up because people would have said, nope, that's a good price. That's a breakout. So the day traders are scalping that trade. It's called a scalp trade. There is a little bit of good news on this chart for you though, Dan. And that is that when we look at the 5 minute or the 10-minute charts, this is now looking in candlesticks of 10 minutes. The fact that the chart hit right here, so we'll call it 118.69 all there, hit that support that it bounced and traded up. The bad news is it also then confirmed that neckline is resistance. Still got to see a few more days, but I'm not feeling it, my friend.
Why don't you show me that day chart again, whatever the one was that you were just showing?
This one?
Yeah, and zoom in a little bit more, like how you had. Yeah, perfect. So you see how you have that right there in the right around June. You got a little bit of a peak there, and it falls down. No, right back how you had.
Oh,
it.
right here.
Yeah, right in there. Yeah, and then we get a real high peak, and then we get a third one. That to me just really looks a lot like a castle to me, buddy. That's the market talking to you. So I see signs, in the chart that maybe you don't see. So
it might be it might be a castle, but you notice how castles, they go up and then they come down and then they're over. Well, same with this castle, buddy. So, but
I think we finally found a conversation that bonds might be more interesting than.
Yeah, I think so. Darren decided to make an example of me today on something that I'm purely following for educational reasons. What else you got, Darren?
It's only because it'll be like 6 a.m. and you'll blow up our Teams thing with all the advisors chatting, saying, yo, you see Disney, man, Disney. And it's just, the middle child in me's got to push a button.
Anyway.
I can't help it. Sorry.
Sorry.
So let's talk about oil, right? Oil continues to do nothing. What I will say, though, is the fact that it's hanging down lower. Let me get on. Yeah, we'll take the daily chart. Actually, we'll do the week. The fact that it's hanging towards the lower end, I actually think that's a good news geopolitically, right? That perhaps some of this peace talk that Trump's been involved with Russia and Ukraine might be actually getting somewhere, because we would see oil going higher if that was not going to happen for us. But it's hanging out to the lower end of that trend for sure. All eyes now on mortgage rates. Sure be nice to see some relief on mortgage rates, because it's looking to me like the housing sector is pretty weak. That was an interesting point, I think, that Bob Elliott had today. Chris, I don't know if you caught that, but he was like, hey, like housing doesn't really impact the economy that much. And boy, that's really different than my perspective on it. I feel like the number one consumption engine for the economy is housing. And we've certainly seen a slowdown that. On some levels, will defer to Bob Elliott and his economic mind. But my experience is that that's where we see a ton of pull through from the consumer.
Yep, I'm with you. I mean, I've always heard that was a big driver of the economy in the U.S., but I'm with you. I'll go with Bob's take is probably the correct take.
No. For those who don't know, and Danny did a fabulous job introducing Bob today, but Bob is like one of the deities of the macroeconomist world. Like, he's a legit macroeconomist, thought leader in the space. Chris and I were just weekend warriors.
And we found a way to say bruh and riz and all kinds of sus Gen Z slang to him. So I think we represented ourselves well.
Way to embarrass us, buddy.
Don't paint me with that brush. You found a way to say that stuff, not me.
Low key, on God.
It's like when I'm taking my son and all his buddies to basketball practice. That's what you sound like, Dan. It's awful. Okay. So Dow Jones Transportation, leading market indicator, looking positive. IWM, leading market indicator, looking really positive. Rates going lower. Well, that's good for IWM and exportability. When we look at SOX, the front end of the risk curve, just peaking at all-time highs right there, just sitting on going higher. That's all positive because the semiconductor is like that front end of the risk curve, along with IGB.
Go back to IWM real quick, just because, small U.S. stocks have really been in this range for, this chart makes it look like it's not been that long, but if you zoom in on that, it's really since 21-ish, we've been in this range, 20 actually, looks like.
Right here. Yeah.
And we've experienced a lot of strength off the bottom in small stocks since April. They've kept up with the large caps. In days like today, they've far exceeded them. So I think that's a really important thing to keep an eye on is even if we see the fading in, say, the Mag 7 and some of the concentrated areas of the market, do the other parts of the market that have just lagged for so long take over and start doing well and lift the overall index and the overall market? Or is this just another false hitting of the ceiling for the small companies in the U.S. and we're going to, go back into the range for another period of time?
I think it's too early to tell, Chris, but yeah, I think that's high likelihood based upon that chart. I would say generally things look pretty strong, though. I want to see some follow through on Monday. The fact that they're talking about lowering rates does also bring up the whole question of stagflation, which is when growth stagnates, but inflation stays high. I think the Fed's running that risk by lowering rates. I guess history will tell whether or not Chair Powell is capitulating politically and how that plays out. But I think the Federal Reserve's in a pretty tough spot right now. Overall, charts look good. Week was okay. Great bounce for Friday. It was not looking like a good week. And I was like, oh, September's here early. And then Chair Powell came out and said, have a dove. We'll print some more money. And that's what you see in this candlestick. It's a bit of a hammer candle on the weekly chart. Still in range, though. Until we break out in range, it's just the float higher until September. Well, we'll close it out for the week. Appreciate all those who hung around with us for the extra 20 minutes on the charts this week. And take care.
Thank you so much. Make sure you subscribe wherever you're at. And we are on the markets from Sonoma Wealth Advisors. We appreciate you checking out the show, and we will see you next week.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. Fermata Insurance. Appropriate insurance is an important part of a financial plan. Find out what coverages you may be missing at fermatainsurance.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Ellaway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax, DBA Fermata Insurance. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.